What if you could sell an investment and legally pay a 0% tax rate on your capital gains this year? It sounds too good to be true, but under the right circumstances, completely legitimate and written directly in the tax code. Today we're breaking down how the 0% capital gains tax works, who qualifies, and how small business owners can use this rule strategically. This isn't a loophole or a risky tax trick. It's about understanding how long-term capital gains tax are calculated. First, let's clarify an important distinction: ordinary income versus capital gains. Ordinary income includes things like business profits, wages or salary, and self-employment income. Capital gains, on the other hand, come from selling a capital asset. And a capital asset generally includes investments like stocks, mutual funds, ETFs, and other investment property, but it typically doesn't include things like business inventory or accounts receivable. So when you sell a capital asset for more than you paid for it, that profit's called a capital gain. But how long you hold that asset makes all the difference. If you hold an asset for 1 year or less, the gain is considered short-term, taxed at your ordinary income tax rate. If you hold the asset for more than 1 year, it becomes a long-term capital gain, and that's where favorable tax rates apply. Long-term capital gains are taxed using a separate set of brackets: 0%, 15%, or 20%, depending on your total taxable income. Here's the key rule that many taxpayers miss. For the 2026 year, long-term capital gains are taxed at 0% if your taxable income is below $49,450 for single filers and $98,900 for married filing jointly. If your income falls below these thresholds, the gain from selling a stock or a mutual fund could be completely tax-free at the federal level. Many small business owners have income that fluctuates year to year. If you have a low-income year, whether due to reinvesting in your business, reduced profits, or timing deductions strategically, you may temporarily fall into the 0% capital gains bracket, and this creates a planning opportunity. Here are 2 practical steps to consider. First, check how long you've owned the asset. If you're close to the 1 year mark, delaying the sale could move you from ordinary income tax rates to long-term capital gains rates. Second, look at your overall taxable income for the year. If it's lower than usual, that may be the ideal time to realize gains and potentially qualify for the 0% capital gains tax rate. This kind of timing strategy can make a meaningful difference in your total tax bill. Paying a 0% tax rate on capital gains is achievable, but only with careful planning and attention to the details. Every situation is different, so always consult your tax professional before making a major financial decision. Looking for more small business finance tips? Subscribe to our channel today.